The best investment strategy. Let's say when Tesla was trading at about 900 and Amazon was trading at about 3,500, you thought that those stock prices were expensive and you didn't want to buy Tesla at 900 or Amazon at 3,500. Instead, what if there was a way where you can agree to buy those positions at a significantly reduced price and also collect money for waiting? That's what happens when you sell option premium. What you could have done is you could have sold a put option with the strike price of 600 and you could have collected a few $100s of premium, or you could have agreed to buy Amazon at 3,000 and collected about $600 by selling a $3,000 put option. David Jaffe with BestStockStrategy.com, and in this video we're going to discuss the best investment strategy where you are paid to buy a stock at a reduced price and you're also paid for your time. The strategy that I'm talking about is selling put options. At BestStockStrategy.com, I prefer to sell put options on large cap market leading stocks at a strike price that are about 10 to 20% below the current market price. The problem with this strategy is that a lot of people, since they get accustomed to winning, they end up selling way too many contracts and they run out of buying power. And then when the market corrects or pulls back by 10 or 20%, they end up being forced to close out those positions for large losses. But as long as you're able to protect yourself against a large volatility expansion event or a large market downturn, then you can earn around 30 to 45 to 50% every single year by selling put options. And in the worst case scenario, if you want to run a wheel strategy where you sell very far out of the money put options, you then take assignment of the position and then you would sell covered calls against it and then simply wait for that position to get called against you. That's completely fine. The wheel strategy is a viable and legitimate way to earn alpha returns that are going to exceed the S&P 500 index. Because, for example, what you would do, Amazon right now is trading at about 3,100. You can sell a $2,800 put in Amazon with an expiration of 2 to 3 weeks out. Then if the market corrects, you can take assignment of Amazon at 2,800. Then you can sell short-dated calls against that with a strike price of around 2,900 or $100 more than the current market price. By doing that, if the position gets called away from you, then you will not only realize the capital appreciation of the increase in the underlying stock price, but you will also realize the benefits of the collection of premium by selling that call option. So in my opinion, this is the best investment stock market strategy. And if you don't want to use margin, because yes, margin is risky, then you can simply just utilize the wheel strategy. This is David Jaffe with BestStockStrategy.com. You can go to BestStockStrategy.com, enter in your email address, and receive over $400 worth of valuable free training. And leave a comment below and let me know your thoughts on what the best investment stock market strategy is. And I appreciate your attention.